You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Byron Carlock, an exceptional guest with more than 30 years as a leader of PwC, the CEO of CNL Lifestyle Properties, and different REITs offices, keynote speaker, sharing Wall Street secrets. Please help me to welcome our guest today. How are you, Byron?
Good morning. How are you?
Thanks a lot for being with us today, and I appreciate you taking the time.
Happy to be here. Is the audio okay?
Yeah, it's perfect.
Good. Thank you.
Byron, your background is super impressive, as I mentioned, with 30 years of experience on real estate and REITs as a leader. But I would like to start with you as the beginning on REITs offices. What was the beginning for you?
Well, I grew up in a family of automobile dealers, and I chose not to go into the family business. And after business school, I was attracted to a very special real estate company known as Trammell Crow Company. You may have heard of it. And so I was recruited to go to Trammell Crow Company after getting my MBA, and really enjoyed the industry. As Mr. Crow used to say, some people think we're in the real estate business, but we're really in the community betterment business. And I think the thing that I love about the real estate industry is it allows us to change neighborhoods, change skylines, change the way people behave in the built environment, and make our lives, frankly, more beautiful through the way we choose to develop and move in our various environments. And so these principles have allowed me to enjoy the industry, both as starting as a leasing agent, a development associate, and then rising through the ranks of finance and capital markets through the various positions. I was able to be an executive at Post Properties, which was very focused on urban living in a reimagined live, work, walk environment. And then went to CNL, where I was fortunate to be a leader in 3 of their REITs, and then came to PwC 11 years ago to run the real estate practice in the US across our various lines of service. And so at PwC, we're not developing anything, but we serve 70% of the private equity real estate funds and 40% of the REITs on the S&P 500, and have a vantage point of offering audit, tax, and consulting services to the major players in the industry as they work to remake our built environment.
So what was reasoning for you to switch from focus as a leader on multifamily and all of the real estate spaces to an actual transition of managing and consulting all of the real estate REITs, the main player, as you mentioned?
Well, I enjoy the vantage point. When I left CNL, I semi-retired and was doing some consulting and sitting on 4 boards. And frankly, I missed being in the mainstream of activity. And I was approached by PwC to consider this different role to be an industry sector leader for the firm. And I really, really like the culture of the firm and the people. It's been a terrific experience. I do have to retire next year. We have mandatory retirement at age 60, and I'm an old man now, so I have to consider what's next as I retire next June. But it's been a great run at PwC, and I'm very proud of our partners and our associates for the service we get to do to this industry, because right now there are some very unique times for the industry as we, on one hand, are trying to rethink how we rebuild our built environment to satisfy changing demands, and on the other hand, doing it more responsibly than we have in the past, given the needs to be more sensitive to the environment and ESG principles. This is a really exciting time, because this particular downturn we're in right now, Adam, is unique from other downturns in that the real estate industry has been fairly healthy, and the supply demand characteristics are fairly much in balance for most product types. You could argue not so for retail and the demand patterns are changing for office. But multifamily, especially industrial as a secondary, are in pretty good supply-demand balance for the needs of society. And we have an opportunity to rethink how we're going to develop this next cycle, which I think is mostly going to be redevelopment of the built environment to higher levels of standards and better environmental sensibility.
So how you see the long-term market fundamental with a new net immigration? For example, right now, the Southeast was a winner on the last last 3 years. The Southeast side was a winner with the pandemic behavior. I think it's reshaped the multifamily landscape because of the net immigration, leaving all of the north side, moving to the south side, especially the Southeast. So how you see the long-term fundamental is going to keep like this and it's going to change forever, or potentially is going to have a reverse net immigration to the north state again, like Washington, New York, and Ohio states, and all of this northern states?
That's a great question. And starting with the end first, the boomerang has already begun in earnest to most of those northeastern markets, and rents have recovered to pre-pandemic levels in most of those markets. And I think there are three things to look at. Number one is affordability. Number two is remote work. And number three is climate and livability. On the affordability, some of our major metro markets in the Northeast and Northwest were consuming 45 to 60% of a worker's income just to find a place to live.
Yeah.
When the pandemic hit, it was a convenient time for folks to say, I'm going to work remotely in a place I can afford. And many people moved to those places and decided they liked it. Number two, the impact of COVID and remote work basically gave implied permission to live wherever you want to live and work however you want to work. As we are now experiencing this recession or pre-recession, folks are having to deal with whether or not they should return to the office to have face time and be seen and remind their employers who they are. We've had over 2 years now of employee leverage that's about to switch back to some employer leverage as employers have to decide with a changing economy and pending layoffs, how they are going to manage the remote versus in-person working. And that may drive migration back to the original offices. But we're also seeing employers say remote working is actually hybrid working is actually a good mix to allow employees to have flexibility while also allowing us to enjoy productivity for giving that flexible arrangement. So that piece. And then the final is the livability and enjoyability of some of the Smile State environments. That not only are they affordable, the climate is comfortable most of the year, although 105-degree heat across the Smile States right now is not very comfortable, but it is generally a comfortable climate, affordable, and most of those states are very business friendly from a taxation perspective. Lower income taxes, no additional city taxes. And so that's really driven people to say, this isn't so bad. But if you look at cultural and educational infrastructure in our established cities, it's very hard to see those easily replicated across all the markets of the Smile markets, especially the cultural infrastructure of cities like New York and London, which have evolved over 200 years. And as we see folks returning to the theater, returning to sporting events, returning to charity events, there's a real appeal to these major metro markets. And you know, there's only one New York, there's only one London, there's only one San Francisco. San Francisco's having some real issues socially right now, with some major social problems as well as issues associated with enjoyable work environment there, but it's still the tech hub. New York's still the finance hub. Washington's still the government hub. Those things don't change quickly. So those cities are not going away, but they're certainly having to evolve.
So potentially is gonna have we can have some sort of a correction on the market, but still the Southeast, in your opinion, I think is gonna stay the winner on the market with more net immigration, with more rent increasement every day, every year, I think, because this was the main, I think, engine for people to start go on the South, and of course, change of the multifamily space, not only the multifamily, that's multifamily self-storage, the offices, especially for example in Phoenix right now, a lot of tech companies moving from, I think, San Francisco to Phoenix. That's similar also on the South State. So this is, I think, in my opinion, the uncertainty about if this market is going to keep growing and growing, affecting the main markets like the metro markets. But I think you mentioned we're not gonna have a major impact on the main metro markets. It's just as the other markets gonna have a better impact, I think.
Atlanta's got it all. For many people have laughed that Atlanta's the Manhattan of the South. Yeah. There are a couple of new drivers in addition to the pandemic migration that have really allowed Atlanta to advance quickly coming out of this pandemic activity. Number one is the affordability that I mentioned earlier of major metro areas. It's very relatively affordable. Number two is the diverse workforce. As we grapple with the issues associated with diversity and inclusion, Atlanta has one of the most educated, diverse workforces for employers to draw upon from nearly 60 institutions. And Georgia Tech is a tech driver there as a very important contributor to the growing technology sector. And then finally, Atlanta's beginning to bill itself as the Los Angeles of the East with their growing studio and production businesses. For the media business to take off in Atlanta, I'm not sure people expected. And it's been a pleasant surprise to the growth of the economy there. Atlanta will have to grapple with some of the issues that big cities like Houston and Los Angeles have with traffic and internal movement in the city. And I think that Atlanta is now trying to focus on strengthening its rapid transit response internally, its living, working, and walking environment in Midtown, the consideration to build over the interstate to connect Midtown from Midtown business over to Georgia Tech will be a big addition like Dallas did with the Clyde Warren Park. Those things make a difference in the quality of life, and it's time to reconsider those investments in quality of life as Atlanta really advances. But it's a market to be reckoned with. It's a terrific market.
100%. As you mentioned before, Byron, you were the leader of two of or three of the REIT offices before BWC. My question was, what I'm trying to ask is, what is from the REITs offices perspective, what is the pros and cons to invest with institutional banks and family offices versus regular accredited investors?
Well, I think the REIT market was designed back in the 60s to allow average investors and the mass affluent to invest in a collection of properties and receive dividends rather than have to have the resources to buy a building and own it outright.
Yeah.
It's if you think about your private syndication business, that's an enclosed structure where you're the GP and you have LPs and you're buying a building and then they are enjoying the returns from that building. REITs are obviously a collection of buildings with the same principles, and there's not double taxation in the REIT structure because the dividends flow through for tax one time as opposed to being taxed at the corporate level first. So it's a very convenient way for Joe investor to own a piece of a property or a pool of properties. As the REIT industry has matured, the sophistication of financial structures often limits the leverage. So REITs are generally low levered, so for safety for the investors, but yet they are liquid. In the public REIT markets, you can sell your stock on any given day and you have liquidity. In the private REIT market, you have the ability to trust the GP as to when you receive distributions and when you sell. And so there are benefits to both depending on the investor's appetite. But the REIT market has grown to become an institutional phenomena as part of an allocation wheel of equities, debt, alternatives, and real estate and private equity have been a big piece of that alternatives allocation on the non-listed side and on the listed side in the equities portfolio. So it depends on your goals as an investor as to what you want and what you require from a liquidity standpoint, but all of those structures are attractive. And frankly, everyone should have real estate in their personal portfolios. It's especially attractive in times of inflation that we're experiencing now, because it's an asset that you can see, touch, and feel, and know that it's going to return you a nice dividend as long as it's occupied. So the risk then becomes performance of the property, but as long as it's performing, it's a good inflation hedge.
From your perspective as a passive investor, if you're investing, what is more, in your opinion, more appealing, the private or the public REITs?
It depends on your investment horizon. If you have a long-term investment horizon, you should probably consider some of the private investments that give you a longer holding period. If you want liquidity, the public vehicles are something where you can park money, take advantage of dislocations in the market, buy low and sell high, as you will, because the REITs are tied to the capital markets, tied to supply and demand for the stock on any given day. And so there is opportunity for purchasing a liquid security that may have upside in the short term as well as the long term. And then private investments, as you choose your sponsor and choose your assets, are great longer term investments for appreciation that you get to participate in on a direct basis for that given property.
Okay. I think this leads to you as an advantage player on the game, how you see the current recession, and if you see an actual similar indication on the market lead to the same 2008 scenario. Like
I don't think this is a 2008 scenario. That was a global meltdown of the financial markets associated with overfinancing of housing generally, and the loss of trading volume in the secondary market for the housing sector. Our housing sector is actually undersupplied, and since the global financial crisis, we have not developed enough housing stock, and lending on that housing stock has been more prudent and regulated. And so this is not what this downturn is about. This downturn is about coming out of the pandemic recovery and being faced with an energy shock, much like the 70s, an immediate shock to the consumer pocketbook because of increased costs associated with energy and now food. The Ukraine war, Ukraine is Europe's breadbasket, has rippled across the world with respect to access to dependable food supply. So we've seen inflation in mostly food and energy. And then that inflation spike has led to a reduction in consumer activity and transaction activity that is now causing companies to rethink their growth rates. We were on a very nice post-pandemic recovery until the Ukraine war. And now that's added a shock. So the real question right now, Adam, is this a short-term correction as we address the impact of the Ukraine war and the energy supply-demand issues? Or is this a longer-term inflation cycle that we're going to have to deal with through fiscal and monetary policy?
What do you think?
It's too early to tell. I do think the Fed's decision to continue raising rates to try to slow it down is what we have to do. Inflation is the worst tax on the poor. Inflation is detrimental to growth. Inflation is something we have tamed in our country since 1984 with great success, and we need to get it under control.
what was the main like factors for the new inflation in your opinion? Is mainly on because of the war, or because of the COVID? Because the prices was going crazy on, especially on real estate. It's a supply and demand also, or?
Well, we were already experiencing inflation in issues tied to the supply chain, construction costs.
Mm.
We saw tremendous lumber spikes that then calmed down. We saw spikes in steel and concrete. Developers really paid a price for higher costs during and coming out of COVID. And then that all of a sudden got exacerbated by spikes in energy and food. So each one of those components of the economy is going to have to be addressed for their specific issues. I think over time, we're watching global trade try to return to a level of normalcy, and supply chain issues persist, but they're not as bad as they were. And so hopefully that piece of it will begin to normalize. Concrete and steel prices depend on production as well as developer supply and demand. The banks are tightening underwriting standards for new developments, so we'll likely see a bit of a slowdown in new development.
Yeah.
So that will it'll give us some time to digest what has been under development over the last few years. Although we are still undersupplied in housing, and we need those costs to be justifiable for builders to build new housing stock. Industrial will probably naturally adapt to supply and demand dynamics. Retail is continuing its transformation that we've been seeing that even started pre-pandemic between the issues associated with e-commerce and bricks and mortar. And retail is actually doing fairly well as they adapt to these transformative behavioral patterns of the consumer. And then office is the big question as it relates to in-person attendance at the office, remote working, to sublease your space or keep it. I was speaking with a large office landlord yesterday who said that Tuesday, Wednesday, and Thursday feels like a normal day. Monday and Friday are becoming flex and remote days. But what happens in the office is requiring reconfiguration of the spaces to feel more like a living room than a cubicle. And people are coming in for collaboration, mentoring, product discussions, strategic discussions, business planning, group meetings, employee onboarding, training. It's pretty exciting to see how we're changing the way we use our office environment for interactive and personal development, as opposed to heads down work. People are doing a very good job of getting a lot of their heads down work done in the privacy of their own work environment, whether it's their dining room table or their home office. And productivity has shown that that's effective, but I'm here to tell you it's not either or, it's both and. We need office and we need remote flexibility. I'm on vacation right now. I'm up at Martha's Vineyard, and I'm on the phone probably 7 to 10 hours a day, but it's a more relaxed environment than being in the office.
100%. I've been I've been in my house, I think, on the last 2.5 years so far. I went to the office, I think 6-7 times on the last 2 years. So yeah, I agree.
But you didn't give up your office.
No.
Yeah.
I still have my office. My next question will be about the recession. What asset class you think is gonna perform well, especially that this current recession is just to control the inflation? Do you think that all of the commercial spaces is gonna perform equally on the current or the proposed recession on the next 6 to 1 year, like self-storages, especially development side? Do you see an impact on the development side?
Well, remember the bulk of our industry, think of the industry like a bell curve. The bulk of our industry is still the 4 major food groups of office, industrial, retail, and multifamily. And each one of those categories has their own opportunities and challenges. Multifamily landlords are in response to inflation and in response to demand, are getting big rent increases right now. Industrial has been getting big increases because of supply chain issues and the need for more storage and the growth of e-commerce. So some large users in the industrial space have said they're going to slow their growth. That doesn't mean the industrial sector is going to slow down, but it may slow its growth trajectory. It may not be, but the supply demand characteristics in multifamily and industrial are still, at least right now, very positive. Office will continue its transformation with a migration toward the higher quality, better buildings in the A category. And I think we'll start seeing some B and C category buildings be repurposed or demolished. And then retail is marching forward with its transformation, which had frankly begun before the pandemic and before this recession, to be more appropriate for multi-channel consumer behavior. Buy online, return in person, shop in person, pick up your online and exchange. This multi-channel, omni-channel retail environment is moving toward a higher level of maturity in the eyes of the consumer as they give us everything we are seeking in a more convenient way. And so I think retail is actually, I think, going to be interesting to watch over the next few years. But I think the biggest opportunity in those four major food groups is redevelopment of existing space, as opposed to so much ground up development. It's often less expensive. It's not as hard on the environment. The real estate industry, with its use of concrete and steel and changing the greenscape of a development, has been a large user of carbon a large creator of carbon. And so I think the ESG movement is going to cause us to be more responsible in redeveloping some of our built environment as opposed to continuing ground up. And then the attractiveness of the alternatives, you mentioned self-storage. I would add data centers, life science centers, medical office related activity, outpatient med facilities. The healthcare industry is driving a changed utilization pattern for real estate in their industry that is taking healthcare out to the consumer in a more effective way, and that requires real estate. They've been the biggest users of unleased retail space, and they've been big absorbers as we look at moving from a hospital-dependent culture to a wellness culture. So I think that's something to watch. And then data centers, life science centers are big growth areas, but it's a small percentage of the built environment. So we don't want to overbuild those, but they are darlings right now, as is self-storage, as the boomers realize their children and grandchildren don't want their stuff. And so they're having to store it while they decide what they're going to do.
Yeah. I see a lot of development on the south side also. Again, the same winner about the self-storage space, especially the development side, besides the actual, all of the multifamily, especially class B and C products, is about, I think 1960s and 70s, a lot of products on a B and C side of multifamily. On the south side is still really all the products, and I see there's an actual growth on the development side, or there's an actual need for a development side on these products.
There is, and there's also a great opportunity for redevelopment and upgrading some of those.
Yeah,
they have that. The garden style apartments were lovely products that were appropriate for that time, that make very nice renovated products. And if you mix and match the large floor plans of some of those garden apartments and the easy walk up, and maybe mix in some mid-rise, you can create a very nice rental community. And rental communities are an important part of our rental fabric. And it's also justifying this build to rent residential single family business. That's also a very big growth area, because our population is more transient today. If you are in one city for one job now, you may not be there 5 years from now. So a rental lifestyle is very attractive to a large percentage of the population. My concern there is that It negates access to, quote, the American dream of building equity in a single home. And so we don't want to ever find ourselves guilty of cutting off access for home ownership, but credit and underwriting standards have been tightened in by many institutions, such that it's harder for folks to buy that first home, and they're certainly more expensive as we look at the price of most major cities. And so I think that's also driven people to rent, and it depends on what it is they want to rent and where they want to rent as to whether or not they want a old style garden apartment with eight units to a block, or if they want a sexier high rise in the urban core, or if they want a mid rise or a pastoral setting in a build to rent community.
100%. I think that the last question will be, within the 30 years, what was that book grabbed your eyes describing the private REITs, private capital, private equity firms? What was a book really grabbed your attention on your career?
Oh, that's a great question. I think, and it's an old one, my favorite book, and actually there are two. I have every one of my associates read the biography of Trammell Crow by William Ewald. He was a great businessman and thinker for literally 103 offices around the world. And then an old book called A Patterned Language is an dissection of why European cities are timeless, and why the buildings in Europe seem to last hundreds of years, and we build in the US to a 40-year horizon in many situations. And so I think A Patterned Language really looks at creating a built environment that lasts, is sustainable, is beautiful. And I want to emphasize beautiful. I think we need to be more conscious of what we build, how we build it, and how it's going to stand the test of time as it contributes to the vibrancy of a community. We all seem to enjoy in our hearts the beauty of walking on a cobblestone street or sitting on the front porch of a town that looks like Mayberry or Seaside. And I think that's worth noting. And A Patterned Language does a good job of talking about that. And when I was working with developers, I would always ask them to read the book A Patterned Language, and they would always come back with great ideas from what they learned from that book.
I will do. My funny question here is, not funny, is actual serious question, is how you describe your superpower after 30 years on the business.
How would I describe what? Your
superpower.
Oh my goodness. My Chinese name is Kurong Kai, which means dancing tiger, which means I can have fun, but also be fierce. And so maybe that's my superpower.
Fair enough. Fair enough. Again, thank you a lot for being with us today, and I appreciate you taking the time. But before we conclude, how the people can reach BWC and contact BWC or reach your associate?
So www.pwc.com, and also watch for this fall at the fall ULI meeting. We'll be launching our Emerging Trends 2023 magazine, which is very widely read in the industry, evaluating some of the trends that we just discussed.
That's perfect. Again, thank you a lot for being with us today, and I appreciate your be our special guest today, and I appreciate you taking the time.
Thank you so much.